I do think it makes sense that it would go higher, but how fast and how squeezed it gets, you just don't know, because things can play out in many different ways. I wouldn't want to be a short in silver right now.
I would venture to say that this mixture of the end of the bull market in government bonds and the takeoff we've seen in gold and silver since the beginning of last year is telling me that the fiat currency regime, which was orchestrated with the help of the Bank of England, LBMA, the Fed, that game is over and they can't hide it anymore.
The precious metals market is signaling a massive shift, and being caught short in silver right now is an incredibly dangerous position. While the exact timing and severity of the impending short squeeze remain unpredictable, the broader macroeconomic indicators are undeniable. We are currently witnessing a volatile mixture, the definitive end of the historic bull market in government bonds directly colliding with a spectacular takeoff in physical gold and silver prices that began early last year. Clive Thompson, a seasoned precious metals expert, alongside Mario Innecco, a prominent macroeconomic analyst, emphasize that the global fiat currency regime is fundamentally collapsing. They highlight that this long-standing financial game, historically orchestrated and maintained by central institutions like the Bank of England, the LBMA, and the Federal Reserve, is definitively over. These entities can no longer hide the reality of fiat debasement from the broader public. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
First of all, Comex continues to be drained of silver. Silver is leaving Comex. It's also I think we're at the lowest level in years. It's also leaving the LBMA. It's about half the level about 4 years ago. And it's also leaving Shanghai, the silver exchange. So where's it going? Well, it's being consumed. And the reason it's being consumed is because the electronics industry is demanding more silver than it's ever demanded ever before. We've had a decade of rising silver demand, much of which is coming from the electronics industry. We've had a decade of falling silver mined production. 4 or 5 years ago, we went into a situation where we passed from surplus to deficit, and the deficit every year now is growing larger and looks like it will continue to grow larger. So the difference between mine supply, which is falling, and industrial consumption, which is rising, that negative gap is getting bigger and likely to continue getting bigger for as far out as the eye can see. So the difference has to be met from above ground stocks of silver. And yes, if you ignore the falling supplies on Comex and LBMA and elsewhere, there's quite a lot of above ground silver, but there's nowhere near as much as there used to be. It's getting less. And as it gets less, you need to offer those who hold that silver an incentive to unload it. And the incentive is a higher price. So everybody has their price. And, the surge in price we saw from, let's say, below $50 to over $100 at one point at the end of January was one of those surges which made an awful lot of people think, that's higher than the price I would have sold at. I'm out of here. So a certain amount of silver came and met the demand. But the evidence is that silver is still which came out, is still being consumed, because we're seeing the supplies at the various futures exchanges dropping. So that nothing has really changed relating to the fundamentals of silver. And I think that it's quite possible, and I'd say more likely than not, that silver will continue to see higher prices as the industrial users, who are relatively price insensitive, you can't stop producing cars just because the price of silver's gone from $50 to $150. I mean, it's what is it, $80? But you're not going to say, I'm going to stop the production line while I wait for the silver price to come down. You're not going to do that. So the demand is relatively price insensitive. The supply is relatively insensitive to the price, because most of the we've seen a higher silver price, but the mine production has still gone down. So what are we looking at? We're looking at silver, which is being mined as a byproduct mostly of other metals. The easy mining has mostly gone, which basically means that any increase in supply of silver is going to be from the mines is going to be very marginal, which means that deficit is going to continue growing. in my opinion, and a growing deficit means that you've got to have a higher price to suck out the above ground silver. The supply and demand, as I said, are very inflexible. This is not oil. I mean, if the demand for oil goes up, they could just pump at twice the speed. That's an easy thing. You can't dig the silver up at twice the speed. It doesn't, it doesn't work like that. You can only get out so many tons of silver per day or per week or whatever it is. So what it comes down to is the demand and the supply. Now, I believe that what happened towards the end of January was a lot of consumers of silver, factories and so forth, who were manufacturing solar panels or electronics or whatever else, they became quite nervous and decided to stock up on something a little bit more longer, a bit more silver than just-in-time silver. So a lot of them would have had relied on just-in-time supply chains, and then they're seeing and hearing the price of silver's going up, the silver supplies at Comex are going down. What if we can't lay our hands on our traditional supply from our traditional source when the time comes? You know what? Let's buy a bit more just in case. And I think that was one of the things which probably accelerated the move upwards. And now we've had, as a result of that rise, this catastrophic fall for many, where we come down from nearly $130 to $65 at one point. Now we're around 80, I believe. 82 perhaps it is today. You'll know better than I, Elijah, because it's literally been very, very volatile all over the place. You blink and the price is $2 different from when you looked before, and it could be in either direction. So I think perhaps now it's come down. That many of the consumers of silver feel less concerned that Comex I won't say Comex. Less concerned that their traditional supplies of silver are going to dry up, because obviously some silver must have come out of the woodwork to drive the price down. The other comment I'd make is about the silver shorts. We've always had in the silver market the shorts. These are big bullion banks, and it's quite a legitimate play. Technically they're probably not uncovered because they got silver in place A, and they're doing the shorting on the futures exchange like Comex. It's a nice, easy way to make money over and above your treasury return, because provided you've got the collateral to meet the minimum margin requirement, your collateral can be earning interest whilst at the same time you're selling a 3-month future, waiting it for it to get a spot month, and the 3-month future is selling at almost always a higher price than the spot month. That's called the contango. So not only are you making it on your money market or your treasury bill that you've got as collateral, you're also making it by constantly rolling over these futures. And from an economic point of view, you probably feel you don't have any risk because you've got the silver stored in London. And again, that might be earning as well, because perhaps on your behalf, they're lending it out and earning a fee for you as well. So the amount by which these bullion banks can go short is unlimited. But of course, when the price starts rising, then they start to say, oh my God, can we get the silver from place A to place B? And we heard these stories about the smelters being backed up and unable to convert the London size bars into the 5,000 ounce bars needed in New York. And suddenly, they although they're financially covered, they got the silver in place A and they need it in place B. Converting to the right, moving from A to B and getting it to the right size bars is not as obvious as delay free as they thought. So there was probably a little bit of panic amongst the silver shorts, many of whom were rushing to close their near-dated contracts, driving up the price as well.
The global silver market is experiencing a severe supply squeeze as physical inventory rapidly drains from major exchanges like the Comex, LBMA, and Shanghai. This critical shortage is driven by a massive collision between a decade of declining mine production and explosive, price-insensitive demand from the electronics and solar industries. Fearing supply chain disruptions, industrial manufacturers are aggressively abandoning just-in-time inventory models to stockpile physical metal. This relentless industrial consumption is steadily depleting above-ground reserves, forcing prices structurally higher to incentivize selling. Simultaneously, institutional bullion banks holding massive short positions are facing extreme pressure. These banks typically rely on London stockpiles to cover their futures contracts, but converting and transporting these physical bars to meet specific New York delivery standards involves significant logistical delays. This physical bottleneck recently triggered severe panic among institutional shorts, forcing them to hastily close near-dated contracts and drive market prices even higher. Let's get back to the interview.
What they're able to do is that they were able to trade a promise as physical for cash delivery and even allocated gold and silver. And the reason why it worked for so many decades is that there is very little need for physical gold and silver. The major banks, financial institutions, investors, they didn't really feel the need to hold physical gold and silver. The dollar was king. Treasuries were going up in value since, let's say, the early 80s. Up until 2020, yields kept going lower. Treasury values kept going higher. Who needed gold and silver, right? Well, they only used it to speculate. Sometimes there'd be people who want delivery, but they could cope with that, even though the LBMA market was highly leveraged, of course. And in this article today, David Jensen goes over that, but he also goes over the fact that the silver market leverage is increasing, distress at major silver exchanges, and they're highly leveraged. What does that mean? Well, they're trading a lot more silver relative to actually how much silver they have in their vaults. And why is this critical now, as he says here in his article? Well, because there's been a silver deficit for years now. I think there's going to be another 300 million added, according to UBS. That's what he says here. And the world, of course, is breaking apart in terms of the globalization is becoming fractured, and paper won't do. There's a rush as well for critical minerals. Hard assets are becoming more and more important. And the bond market, most important of all, treasuries and other government bonds, they've been in a bear market since 2020. And I've shown you many times, if you've been watching me for years, this long-term chart of the 10-year yield, US 10-year yield. You can see that the downward trend, which is very positive for treasuries, the dollar, and keeping gold and silver under control, that trend has been broken, which means yields now are going up, interest rates are going up, and it's a bear market, and bond prices are going down. And that's why central banks, sovereign wealth funds, big investors now want the real physical gold and silver, because treasuries and other government bonds are becoming risky. Ever since this war kicked off in Iran, in the Middle East, U.S. Treasury yields have risen, and they're up this morning here as I speak. And it's 8 a.m. London time. We've got the 10-year yield up another 4 basis points, approaching 4.15. We were below 4% before this war started. The 30 years up another 4. It's approaching 4.80. So not good. And I would venture to say that this mixture of the end of the bull market in government bonds and the takeoff we've seen in gold and silver since the beginning of last year is telling me that the fiat currency regime, which was orchestrated with the help of the Bank of England, LBMA, the Fed, that game is over, and they can't hide it anymore because investors have woken up, or a lot of them have. So David Jensen says here, silver critical, with only a fraction of annual physical silver demand held at primary exchanges globally, and with increasingly restricted market liquidity of silver, silver's price warning signal has been sounding along with gold. that all is not well in central banks' fiat currency world. Interest rates have broken higher out of a multi-decade downward channel for government bonds and are following gold and silver's path higher. Well, there you go. That's what I told you. And it's broken that relationship that the mainstream economists and central bankers thought would always hold. And what is that? Well, that if yields started going higher, gold and silver would go down because real yields would be higher, right? That's not happening. So I'm just going to summarize here the leverage. And then you can read this whole article. I'm going to put it in the description, a link. It says silver leverage. These primary silver markets, so the primary markets are the LBMA, the Comex in the US, the Shanghai Futures Exchange, and the Shanghai Gold Exchange. All share brutal leverage with far more claims than there is metal available for delivery. The greatest leverage problem lies in London, where the vast majority of claims traded in London, in the London silver market, are for cash spot silver with immediate delivery on demand. Well, in the past, that wasn't a problem. So all these primary exchanges only have 199.3 million ounces of silver. That's what David Jensen has estimated. And yes, he says here leverage works both ways, right? He says with the growing global silver shortage, the world's major silver exchanges currently have 199 million of vault stock available against billions of total claims in the market. And UBS estimates that the global market will see another further 300 million of deficit of silver supply in 2026. Of concern is that since the onset of the attack on Iran, government bond yields have run higher due to selling of these bonds. We can be sure that given the global run on physical silver and gold over the past few years, this was not the result that was hoped for by debt-reliant governments.
For decades, the global financial system functioned smoothly on paper promises, with institutions trading allocated gold and silver without ever demanding physical delivery. The US dollar reigned supreme, and government treasuries enjoyed a massive bull market that kept precious metals tightly suppressed. However, that deeply entrenched dynamic has fundamentally fractured. Treasury yields have violently broken out of their long-term downward channel, signaling a definitive bear market for government bonds. As traditional safe haven debt instruments become increasingly risky, central banks and sovereign wealth funds are aggressively pivoting away from fiat derivatives and demanding immediate access to real physical assets. Share your thoughts in comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive precious metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.